This evening's presentation formed part of the Financial Planning Association of Australia's Financial Planning Week celebrations, and we're proud to play a small part in that. This evening, my colleagues Andrew Hewison and Glenn Fairburn will present cases for shares and property investment. But before we launch into the detail of the presentations, we need to consider the bigger picture. The economy affects all asset classes, including property and shares. So, to bring us up to date with the current economic state of affairs, please welcome Hewison Private Wealth CEO and Private Client Advisor, John Hewison.
Thanks, Chris. Good evening, everybody. I'll try and put some sense into the economic situation at the moment. Before that, I'll just touch on the recent federal budget and the issues that came out of that. I think it's reasonable to say that the budget was more of a steady-as-you-go approach. There weren't any real revelations that came out of the budget, but the government's still determined to get the economy back into surplus by 2012-2013, and its method of doing that is to achieve $22 billion in savings and to restrain any real growth in spending over the next couple of years. But there's also the issue of surreptitious revenue raising through things like carbon tax and mining tax. And of course that's one of the issues that we're facing at the moment, because there's a great deal of uncertainty regarding those two issues. Of specific interest to us in the financial sector were some announcements made by the government. First is the easing of excess contributions tax. Now, excess contributions tax applies to the maximum caps put on contributions to superannuation. For concessional contributions, that is contributions for which you claim a tax deduction, the cap is $25,000, except for those over 50, where the cap is $50,000. For non-concessional contributions, the cap is non-concessional is where you don't claim a tax deduction, so therefore it's tax-paid money, is $150,000 a year, or $450,000 averaged over 3 years. The excess contribution tax is 46.5% if you exceed any of those caps. So that if you make a non-concessional contribution and you've already paid the maximum rate of income tax on that money, that is 46.5%, you get taxed another 46.5%, which means that you're taxed 93% on your money. This is absolutely outrageous. And this tax is probably the worst case of taking advantage of innocent people that I've ever seen. I mean, no one's going to make an excess contribution because there's no point. You can't get away with it. So they're only made accidentally, and it's not difficult to do, particularly with the 2-year bring forward rules. The government has announced that for any excess contributions on concessional contributions up to $10,000, that the contributor will be able to either recoup the money and pay marginal income tax on it. It's a concession, but a very small concession. There was also announced that the 50,000 contributions for those over 50 will be continued for those who have a superannuation account balance of less than $500,000. And the account-based pension minimum, which has been halved in the last 2 years, will now be set at 75% of the statutory minimum level. So if your statutory level is 4%, the minimum level will be 3%. This, of course, is after the reduction in superannuation account balances because of the global economic problems. So let's have a look at the economy. And what I've done is look at the positives and the negatives of the economy. On the positive side, we've seen over the past 2 years, or a little more, that the major developed economies are doing well post the global financial crisis. The US, Germany, France are all in positive GDP growth. Particularly Germany and France have done extremely well in recovering from their previous recessionary direction. Growth markets of India, China, Asia, Russia, Brazil and Australia are all doing very well, and that looks to continue for the foreseeable future. There's been plenty of rumours around about the future of the sustainability of growth in China, and the reality is that over the past 30 years, the movement of population from urban to from rural to urban affluent has been 200 million people. In the next 10 years, it's expected to be another 200 million people. I mean, it's just, the numbers are extraordinary. I was talking to a client of mine just today who's just returned from China, and he said it's just, you can't imagine just what it's like, the level of growth and the activity that's going on in China. So we don't see that there's going to be any slowdown in the Chinese growth story for at least a decade. On the negative side, the biggest concern and the thing that's really hampering the financial markets is the euro credit issue of Portugal, Ireland, Greece and Spain. Now these countries have been in financial difficulty, and they've been bailed out, so to speak, by the IMF, the International Monetary Fund, and the European Economic Union. Greece in particular and Portugal still remain in problems, and part of the deal, part of the bailout deal, was that they put in place certain austerity measures to fix their problems. You might have read in the paper last week that the Portuguese government dismissed these austerity deals and forced the Prime Minister to resign. This reminds me of the late 90s when the Asia credit crisis occurred, and a number of Asian economies were literally broke and at the mercy of the IMF, and the IMF said exactly the same thing. We will help you, but only if you fix your problem. And that's what's going to happen here, that eventually these countries are going to have to make sure that their austerity measures are effectively introduced before the IMF will support them any further. There's obviously continuing concern over the US debt. Their debt is just astronomical. But let's not forget that the US economy is still the biggest economy in the world, and the economic gurus don't seem to be in the least bit concerned about America's ability to handle its debt, get back into growth, and overcome the problem. Bearing in mind also that the US economy is about 70% consumer driven, so they're very much internally capable of dealing with their problems. In Australia, everything is looking positive. The mining boom is booming and will continue to boom. As I said before, the China outlook is sustainable. The GDP growth forecast for this year is 4.3%, next year 4.25%. They're very good numbers. Unemployment sitting at 4.9%, which is effectively full employment, and that's a problem because we don't have any growth capacity. Whilst we've got growth potential, we don't have the labour. So that's one of the issues that we have to deal with. So why isn't Australia doing better in the markets? And it's really because of uncertainty. We've had all of this bad news about Europe. We have uncertainty surrounding the carbon tax and the mining tax. Nobody quite knows what that means in terms of increased expenses, living expenses, or even job threat. We have political instability and a parliament that's really behaving itself atrociously, and we saw more of it again today, where both sides are just throwing stones at each other and not getting on with the business of running the country, and of course that's a worry to everybody. Well, it's an upsetting concern for everybody. There's still a hangover from the GFC that people aren't confident, and it's a bit of a catch-22. The market's looking for confidence from the investor, and the investment's looking for confidence from the market. So this will just be a matter of time before it works through. The Australian dollar's strong, which is good for travel and flat screen TVs, but absolutely shocking for our exports. The issue for foreign investment in Australia is that with a historic average value of the Australian dollar against the US of 80 cents. We're now sitting at 105, 106. But the reality is, as we hear from the experts, that it's likely to stay that way. That it's entered a new paradigm. Australia's seen as a much more robust and strong economy, and the dollar is unlikely to get back to its previous levels. But it still would be seen as a foreign investor as a threat. Investing in Australia at a $1.06 exchange, with the possibility that they could lose 20 to 25% on an exchange rate downgrade, there's going to be some hesitation. But it'll all work through eventually. Looking at the Australian share market, we see that it's certainly undervalued and it really needs a confidence spurt. There's been massive mining infrastructure spend. The big miners, BHP, Rio and Woodside Petroleum have put tens of billions of dollars into infrastructure production, and they're all due to come on stream very soon. The Woodside gas production infrastructure is coming on stream in the next month or two, which will see almost a doubling of their production capacity. And there's $90 billion of more infrastructure on the table ready to go. So the growth potential in our mining production is just massive. The market generally is showing the price to earnings ratios are low and dividend rates are high. To give an example of that, if we take the banks as a sector, the bank's average PE ratio, that is the average of the relationship between price and earnings, is on a multiple of 10.6. The long-term average PE is around 13, 14. Average dividend rate amongst the banks is 6.3% fully franked, which extrapolates out to better than 9%. The 10-year average is 5.3% and the longer-term average is 4.7%. So that indicates that there's something like a 35% upside potential to get those relationships where they ought to be on the long-term average. So we see that there's a lot of opportunity in the Australian share market right now at the quality end of the market. So in summary, this is our view, that the world will gradually emerge from the GFC over the next however long, but hopefully in the next, when the predictions are, the next 12 to 24 months. The Australian dollar is likely to remain strong. The recovery outlook is very positive. The Australian share market outlook is very strong. I mean, we're still lamenting at less than 5,000 points. The upside is, I can't give you a time frame, but it's a good time to invest in. The Melbourne residential property market is starting to cool, and probably with the likely increase in interest rates, it'll continue to cool, although we've seen today a negative growth figure, which was expected because of the floods and etc. So interest rates will probably be on hold for a short time. And the Melbourne commercial property market is starting to look attractive after a couple of years in the doldrums. So that's the way we see it at the moment. We all need to stay positive, and all the indicators are very good.